So welcome, ladies and gentlemen, to FHFA's inaugural Velocity TechSprint. My name is I Diallo. I am a program manager at Alliance for Innovative Regulation, and I would just like to go over a few housekeeping items for our audience. Please submit any questions and comments using the chat feature, and please keep in mind that this session will be recorded. So without further ado, today our panel will focus on using data as a competitive advantage, lenders in the age of fintech. Now, without further ado, I would like to hand it over to Faith Schwartz, founder and CEO of the Housing Finance Strategies.
Well, thank you, and thank you for all the work that AIR has done along with FHFA to bring this tremendous sprint experience forward for the industry. We have a terrific panel today, and I'm going to introduce each of them and then ask each of them to talk about what they do and a little bit about their business model before we get into our questions. We have David Batney, the Executive Vice President of Capital Markets for Guild Mortgage. David was an executive with PennyMac and a longtime director at Fannie Mae as well of their single family business. We have Eric Schmidt, executive at JP Morgan Chase. And Eric is the head of marketing transformation and Chase Consumer and Community Banking. We have Jennifer Kuchis. She's a chief mortgage banking officer for Vi System Credit Union, who's also a CDFI. So that'll be really interesting to hear from Jennifer. And then last but not least, we have Steve Majerus, CEO of Synergy One Lending. And Steve and I are both fortunate to be judges in this as well. So we're excited to be here. And I think we should just get going. So Steve, why don't we start with you? Tell us a little bit about your day-to-day and the company you run.
Sure. Thank you, Faith. And thanks for my fellow participants on the panel. It's exciting to kick this off. As Faith said, I'm the CEO at Synergy One Lending. I have been with Synergy One for about 6.5 years now. And what's exciting for me, we're a distributed retail model wholly. We operate in physical footprint in about 15 or 16 states, licensed in 49. And exclusive to a branch model system throughout the country. What's exciting times for me here is I draw a lot from my experience during the dot-com boom at a company called eLoan 20 years ago. So a lot of the things that we're going to talk about today, then I see innovation in the space are things that we really were working on 20 years ago, frankly. It's good to see this innovation starting to see the light of day. So thanks again, Faith. Appreciate it.
Okay. Thank you, Steve. And now why don't we jump to you, Eric, and tell us a little bit about your role at Chase and about Chase's model.
Sure. Thank you for having me. So I currently am the head of marketing transformation for CCC businesses. Prior to that, though, I was the head of product innovation and consumer insight for our home lending division. So that's where my zest for innovation and bringing solutions to customers has originated from. Chase, as many of you know, it has both a distributed as well as a centralized sales force within our home lending division. We have a correspondent channel as well, and then we have an investment bank that does private label securitization and whole loan transactions. We also hold large mortgage-backed security holdings, so we kind of, in the ecosystem, we're involved in almost every aspect of the lending business.
Yeah, that's going to be really interesting to hear from you with that model. And David Batney, who's with Guild, you've also got a big, expansive company, and tell us a little bit about your role and what Guild's model is.
Thank you, Faith. I have the privilege of managing capital markets and product strategy at Guild. We are a very distributed retail business model. About 98% of our volume is through that channel. We do have a very small correspondent channel that we have as well. We operate in 49 states and the District of Columbia. And what makes Guild a little bit unique is we retain loans, but we do it on our own proprietary platform. And we have a proprietary origination platform, which are all managed by Guild employees based in San Diego. So we are a little different in that respect in terms of all in one house and one office.
Yeah, that, and especially for tech and innovation. So that'll be fun to hear from you, David. Jennifer, how about you as both a CDFI and a credit union?
Absolutely. Thank you so much for having me. So we are the 13th largest credit union and probably serve over 900,000 members with 70 branches and growing. I oversee all aspects of real estate lending. So we have a wide area of focus, which is centralized, and that includes mortgage loan sales, operations, secondary, quality control, servicing, LawSmith, and then also we have a CUSO that offers title services. As a CDFI, which you mentioned, we have additional focuses are leading critical initiatives such as product development and financial resource planning. I'm really responsible for the strategic vision and blueprint to implement innovative solutions, product development, process improvements, and training as well. So proud to be here and excited.
Yeah, it's exciting. Well, all right, let's get started. So data as a competitive advantage means a lot of different things to different people, and it is different among different types of models. And Eric, I thought it would be great if you could kick us off, because JP Morgan is unique with their data set, their bank, as well as non-bank customers. So can you talk to us a little bit?
Sure, absolutely. So, one of the ways we've used our data, to better and make more products available to our consumers is for customers that have a direct deposit relationship with Chase. We have developed a proprietary algorithm that calculates income. And through testing, we've validated that income will be widely accepted by both GSE models, not the calculation, but the inputs will derive a similar output from GSE models, so we're confident in verifying or offering pre-approvals. And we've used that for two paths. So for purchase, we are able to provide customers upfront purchasing power. So they're aware of what their current income, would allow them to purchase in terms of home price and mortgaging. And then we also couple that with our purchase close guarantee. So our end state vision is to provide customers with the ability to get as close to a cash offer as possible through digitally verifying income, assets, employments, and then combining that with our purchase close guarantee, which offers the customer certainty and our commitment to close on time. And that gets as close as possible to an all cash offer. The one piece I'll say on purchase, and it's true for refi as well, however, that we only use digital income to qualify customers. If the customer does not qualify on that income, we'll use a traditional underwriting approach. And we still offer verified pre-approval for customers, and the purchase close guarantee is also offered for customers with a traditional underwriting path. The other thing, which, was really powerful is during the refinance boom, we are able to couple our digital income verification with some of the GSE innovation around appraisal waivers and offer customers pre-approved locked-in pricing for refinances where the customer had no closing costs. Mm-hmm. And what we really saw here is a significant shift in our production to low to moderate income lending, because what happens is by eliminating the customer paying of closing costs, it effectively reduced the pricing point or mortgage balance to which refinance made economic sense. And as we talk about innovation and driving financial inclusion, when you reduce the fixed costs, it generally expands inclusiveness of participation in the refinance market. And that's what we found. Customers with lower loan balances were able to take advantage of the lower rates. Mm-hmm. And some of the closing costs offset were achieved through a significant reduction in underwriting costs, because we're able to digitally underwrite the customer, as well as the GSE innovations of appraisal waivers, where the customer, there's no external cost for appraisal. So, bringing together multiple innovations together is where you have those, moments of like significant cost savings for consumers, expanded access.
Well, Eric, 2 nuggets, and for our audience and attendees, wringing out those costs of the, origination of a mortgage, as we know, I think it just hit its highest cost structure for lots of reasons at $13,000 alone. Leveraging data to get those costs way down. And re-looking at some of the, other cost structures within it will really make a big difference to the low and moderate income borrower. And that's what we're all trying to do. So thank you for that. And I also think no denials on digital. I like that just because, we're looking for inclusive lending and finding ways if it was understated on their income. So thank you for sharing that. I'm excited to hear from David at Guild, because they're doing some really creative things there as well. So David?
Sure. Well, what's exciting about having our own origination platform and servicing platform is they can talk to each other, and we can get a lot of data between the systems about the borrowers, about the mortgage, about the property, and then connect the dots and make it into useful information. And so we've been able to look at data and how it correlates to future loan performance and just have a lot of additional insights that helps us potentially better price and manage risk and also open more doors to more borrowers. So I think there's just a lot of exciting potential in how this digital data can be used for a lot of purposes. But the fact that in our platform, we control the data and it's managed by Guild employees and working in the same building that we do is, creates a very sort of powerful connection between the borrower's data, the property data, and the mortgage data.
David, one add-on to that, we've had so many sources of data, and it's hard for people who are not close to this issue. I'm close to it because I've done some work with some of the data aggregators and execution folks in that area, but it's not always obvious what data can be used. Can you talk about the importance of source data?
Sure. I think a very exciting future for the industry is what we sometimes call bank account data. It could technically mean banking and or credit card data, but basically the consumer's payment data, but also shows deposits of income. So as an industry, we first, this has been around for a while. We just haven't really been using it. It was used for just 2 or 3 months of bank statement verification, and that was pretty much it, even though the data was much more powerful than just that. So over the last year or so, we've seen the GSEs morph and allowing pilots where you can use the data to 12 months deep and use it as a verification of income, employment, and assets. And what we've been using with our portfolio to look at performance numbers is we can also use the data to have a very strong correlation to compare residual income and how that might impact future loan performance, to just give an additional way to measure a person's ability to repay beyond traditional credit scores as a primary method.
Yeah, thank you, David. Well, I'm sure we'll be talking more about importing and how we leverage all that additional data. But Jennifer, it'd be interesting to hear from you on how you're serving more customers. You're a very member-focused and mission-based organization. Can you talk a little bit about how your company leverages data for competitive advantage?
Absolutely. So this is something that we're really passionate about, and there's a couple of new things that we're working on. One of the items that ViStar is working on is partnered recently with FinLocker and our upcoming mortgage financial wellness tool and program, and we've labeled it Dream to Own. And we're really excited about that. To give you a little bit of background, FinLocker, it's a secure financial fitness tool, and it takes data, it aggregates it, it analyzes it, and based on the consumer's financial data, it offers a personalized journey for our members to achieve, the goal is loan eligibility for a mortgage. And so what we really like about this is we really wanted to be intentional about how we would use data. We talk a lot about data for good, and we wanted to innovate in a different way. So we're going to be piloting the tool initially to those who are having approvability challenges and also our local Habitat affiliates. And so we're excited about it because we believe that Dream to Own will help ViStar in its promise to bring financial freedom and inclusion by meeting our members where they are. And, one of the things that we talked about is homeownership, building generational wealth. But a lot of times people don't talk about sustainability. And so sustainability is so important. If you think about the grants and the down payment assistance programs, you take a, 30-minute to an hour course, does that really set them up for the tools to be successful? It doesn't. And so with this platform, we really see that there's HUD certified counselors, there's, credit counselors, there's all these different pieces of the puzzle. And what we did is we didn't want to just take the technology as is. We really wanted to create a team focused around this that would support our members and walk them through every step of the way. So trust is a big piece. When we partner with our Habitat for Humanity partners,
Right.
Locally, it's Habijacks. They're hesitant on what information. And, I think that unfortunately, they've had bad experiences in the past. And, if they were declined for a loan, they weren't really given a lot of information. And so what we want to be able to say is not right now. But this is what we're going to do to support you. This is how we're going to help you. And we're going to create this process and really get them back in the funnel and be able to help with that wealth building through homeownership and sustainability.
Wow, that's excellent. And I, I love the whole partnering in third parties and trusted third parties who many people really appreciate through the process.
Absolutely.
Some things don't change, right? That's important. Steve, I know you also leverage a vendor to drive adoption for consumer asset reporting and leveraging your progress around income, asset, and employment. I'd love to hear how your company is navigating this issue.
Yeah, we've kind of, our philosophy has been we'll adopt and innovate with fintech partnerships, et cetera, whenever we can improve the customer experience, more of a real-time feel, like consumers view their experience on Amazon or other ways, where we want things now, where we can get things now. And taking that to heart in designing our own upfront experience for consumers, we've embedded that opt-in or self-serve component for consumers to be able to verify their own income, assets, and employment during the application process itself. What's interesting, we've been doing this for 4 or 5 years now, is that particularly we saw an acceleration like most did during the pandemic, but even before then, people were getting used to doing those types of things.
Yeah.
And so we saw adoption rates at the consumer level that were self-serving verifications at least 50% of the time on at least one of those components, which are just so critical to a credit decision. Yeah. And frankly, getting loan officers on board, we've been at it for a while now, was a key to getting success around that, so that they can script themselves in a new way and present this with confidence to consumers that this is not a function of replacing a loan officer in the process. It's a function of improving their experience and getting to the finish line faster with certainty. And I think over time, that adoption rate, both among our loan officers, are the rest of our kind of loan manufacturing team members and consumers, has kind of synced up in this what we've created at this point. It also, we're still working on additional solutions to be able to reduce costs in our manufacturing process. But one of those things that I've learned, at least for our company, is you got to go for some of these things. You have to go all in on these for your whole organization to be able to get the benefit of that ecosystem you're creating. So both for consumers and for longtime mortgage industry employees, it's a unique challenge to both.
It's true. And we're, of course, in one of the roughest markets we've ever seen. And I've been around a long time in this market, but hard to be a hybrid player, push to adoption when you're not seeing those cost savings. You might see a slight increase in cost until you straddle it and get there. And I'll be curious later on, we'll talk a little bit about adoption. And is it mandated? Is it not? What's the culture in your organization? And as a CEO, do you kind of lean on people to adopt?
Yeah, it's one of those things. A former mentor, and frankly, during my years of in the business, if I'm not willing to lead by example and lay out the vision myself, and within every organization, you always have early adopters, and you have kind of the wait and seers, and then you've got a faction that just never want to change at all. But so I felt it was my incumbent upon me to make sure that I made it a priority for the company, that this was going to be our DNA for the future. And I never wanted our sales force to feel like they were being disadvantaged by watching a huge lender, online or offline, deploy technology or leveraging data in a way that we couldn't or didn't because of our size. And I think access to solutions that provide, whether it's data or other technology, really levels the playing field for companies like ours to be able to compete.
It does. And by the way, that's kudos to FHFA and the GSEs. They've always been excellent at leveling that playing field that was unattainable for small and mid-sized lenders. I think that's one of the best things they can do in the market.
Great.
Okay, let's pivot a little bit and talk a little bit about enterprise risk. And Steve, since we were talking about you, in what ways do the data and tech play into the enterprise risk management? As you know, we're talking about chat GT, robotics, blockchain, AI, in addition to, all the bank statements. 3D scanning is a big, appraisal, augmentation. How are you thinking about it in risk management? And we'll do a little round robin here.
Yeah, it certainly comes up with every time we want to create a new partnership with any fintech solution. And part of it is just managing those multiple partnerships, because those fintech companies sometimes just focus on one solution they want to bring to the table, and we have to figure out how it integrates with several other components in our ecosystem we're trying to create seamlessly. And I think certainly we rely and whether it's source data or otherwise, our philosophy is that this actually improves accuracy. It improves the data integrity that's being accessed and presented. And I think it's just it really is, the question is, have we built the pipes in our manufacturing process to be able to get it to the right places so it's actionable, accurate, and can be either automated or otherwise validated. And I think there are enough embedded solutions that protect companies and protect consumers. But I think we view ourselves as being, wanting to innovate in these areas and really help push along these solutions. So they're real use cases in the market that both protect the enterprise holistically, but also care, obviously for the investors we sell loans to, and being able to, frankly, extract lifetime value out of our client base a whole lot differently.
Excellent. And let's see, how about you, Jennifer, and thoughts on the enterprise risk management piece of this?
Absolutely. I mean, I'll echo Steve's points and say, it's important to have good partners, because I think that there's some really exciting fintech that's out there, but making sure that it aligns with, your risk appetite for your organization, and also making sure that, we're highly regulated, and making sure that it aligns with that. Sometimes we'll see demos and things like that. You'll ask questions on their controls and their process and things like that. And those are things that you really have to ask. You can't assume that that's happening, especially with, we talked about it earlier, rising costs to originate. It's really, really important, because it helps to really streamline that process. You gain efficiencies, and you're able to immediately kind of move data through, leveraging technology, and really it will enhance the quality control processes. We've implemented special bots and tools, and been able to leverage to create, quality control workflows, audits that, our staff can immediately rebut, and alerts through the journey to make sure that we are adhering to regulatory requirements, which is so important, not only in just the upfront origination process, but then the long-term longevity and performance of your portfolio. We also obviously maintain servicing and loss med everything in-house. And so that's important for us that we have, not only we originated on the front end, but it performs, and that it's saleable. The loans that we do sell to the GSE, we do, other products too, and proprietary programs, but definitely it allows speed, quicker decisions. And so we're excited about it, but just making sure that, that you're validating the data and that there's controls in place.
How about you, Eric? Thoughts for Chase on how it's impacted your enterprise risk management?
Yes, absolutely. So anytime you can source data directly from the source, it's, which is some level of fraud risk in the industry. Secondarily, there's a good opportunity to study consumer behavior and understand what mitigating factors can you see a customer profile, such as housing payment prioritization, that will potentially mitigate another derogatory event. And we've seen some of this advancement to the GSE's use of rental income to augment a credit file and potentially approve a customer that would be ineligible. So there's a way to expand access to credit without truly increasing credit risk across the industry, which is something we're really focused on, as a lender and a portfolio lender as well. The last piece is more of an educational piece because we have a large consumer base. We want to use this as an opportunity to provide them information about what their rental payment would mean in terms of housing homeownership, even where the customer may not have a FICO. And if you think about things that are very time consuming, like a non-traditional credit underwrite, technology would allow us a way to automate that in a very efficient way to expand access, both in terms of knowledge education, but also the fulfillment process. So we kind of take like a 360 view of it and trying to drive full financial inclusion and then expand credit without increasing risk.
Yeah, I do think Chase has more data than most people, and it's really wonderful when you can really make it actionable the way you do. David, how about you at Guild?
We're working on similar things, and I think what really illustrates was the example that Eric was just describing. So we looked in our portfolio to see how rent payment history correlated to default. And when you think about the way it's an industry today, how we look at non-traditional credit, you have a human underwriter trying to gather 12 months of rent checks and then call a phone number and a name and hope it really is the landlord that received them.
Yeah.
And if you get that data directly from the source, there's less risk of fraud. But also it allows the industry to better see the data, because it's a very difficult process for a human to have it in 2 seconds versus a human trying to get dozens and dozens of PDF pages. It's just a much better way to assemble the data. The data itself is more accurate and reliable, and it'll just produce a better risk decision at the end of the day.
Yeah. Well, David, this is great because it segues into our next discussion. I know, and I think we have a slide that you want to present on this, but we have a lot of alternative data that's being talked about, and we for some years have had trended credit data. We have utility, you have rental, you have other bits of data coming in, and it all sounds good. We even have credit scores. We have 2 credit scores approaching into the market with Vantage Score and the new FICO, as well as bi-merge instead of tri-merge credit reports. There's a lot going on. So yeah. Let's talk to us a little bit about that and how that's coming through and how that's going to get executed.
So the way I would summarize what's going on is, as an industry, when we adopted credit scores as a very efficient way to sort of add transparency and quality to risk, it was a very impactful time to do that. However, credit history to be meaningful and be predictive, you need many accounts over many years. And so it is a challenge for people who may have fewer accounts for fewer years in terms of trying to estimate their ability to repay. So the industry is clearly recognizing the value of going beyond just credit account payment history, looking at the history for rents, utility bills, and looking at other income sources. So where I see this going for the entire industry is this electronic data just gives us additional lenses. So we might think of it as like a 3-legged stool, where payment patterns on credit accounts is one leg, payment patterns on non-credit accounts like rent and utilities is a third leg, our second leg, and then the third leg would be residual income. And what's really powerful about residual income is, for it to be powerful and meaningful, you don't need 10 years of history. It's really 2 years, even 12 months is very predictive. So it's very opposite, where credit history needs lots of accounts for many years. Residual income is very predictive with 12 to 24 months. So I think it does open the doors, especially for first-time home buyers who maybe have limited credit use or maybe even potentially no credit score. Yeah. So I think it's going to be a key part of how we evaluate credit risk as an industry moving forward. And is that slide? Is
there a slide? Yeah, that would be helpful, because I know you've already been doing some work in this. I know with your partner in crime.
Yeah. So so we work with FormFree as our partner, and what FormFree does is takes the digital bank account data and they produce a residual income knowledge index, or a RICI. So it's a index level. And we looked at this index to see how it correlates to loan performance by similar credit scores. And so we found a very, very strong correlation looking at several thousands of loans over about a 6-year history from our servicing portfolio. So what this does is just gives us as an industry kind of an additional way to look at a human, especially if they have limited credit accounts and they really can't have an accurate FICO or a credit score. And the use of the RICI score is a better way to look at them, or the RICI index.
So another way of augmenting opportunities and bringing people into the system. And I think we're going to hear and see a lot more of this. And the second part of this will be, how do you execute and carry new data all the way through the system, and not just to lead generation, not just for purchase, but actually looking for resiliency and performance, monitoring, tracking the performance of what's been brought into the system.
Absolutely.
So there's a lot of good stuff going on out there. It's exciting. Steve, did you have any thoughts on the alternative data sets that you're thinking about accessing?
Yeah, I mean, first of all, I applaud Guild and Form Free for actually implementing a solution like this, which somebody has to be first in things like this, and particularly with Guild Scale, kind of taking the reins and bringing this to market. I always applaud and love to see that because it benefits everybody in the future. I'm watching now the use of alternative data in other consumer loan categories that have been generally accepted for 2 or 3 years now. And I think some of it is still to play out in whether it's buy now, pay later, or personal loan space and things like that. Credit decisioning, where instant credit decisioning is done digitally, but using alternative source data to assess credit worthiness is, I think, could be instructive for the mortgage industry. And again, given that don't have to reinforce it. However, we are known to be a little slower at adopting some of these things. And so I'm hoping before I retire, some of these ideas can see the light of day so that we do see the real results of these things in real life and increasing the inclusion objectives everyone has.
Yeah, I think so. And I'm hoping this FHFA TechSprint is that impetus, that catalyst to get us moving, that velocity of the speed of which we start adopting and executing. So it's an exciting week. All right, let's talk a little bit about execution when originating, closing, and securitizing loans. How does the granular approach to data, DTI, pricing, execution start to play out with, more data, nimble and savvy tech, and how do you stay competitive for the customer, but also the credit investor, the GSEs, private balance sheets? And Eric is expert at this, so we're going to have him kick us off on that.
Sure. So in terms of competition, I think, said before on the panel, the digitalization and the simplification of the process will be a customer expectation going forward, and it will be needed to compete on a cost advantage. So digitalization, I think, is a critical component of the future. In terms of enablement, there's a couple of things I think we need. One is, as we balance, there's a key word for this, balancing innovation with the impact of that innovation. For example, like if we were to introduce a DTI loan level price adjuster, while that may have the ability to achieve a capital outcome, it will also stifle innovation, because we know, generally speaking, when early verification techniques are adopted, there's some level of conservatism built in. And if a DTI is a differentiator, if I qualify the customer at a 39 DTI and then I have no DTI adder, but if the customer qualifies digitally at a 45 DTI, then I have to reverse course and then collect that documentation, increase cost, which is eventually borne by the customer. So as you think about components of the pricing structure of the industry, we have to balance the ability to raise capital and the precision of that pricing risk with the ability to still support innovation and look at the total sum of that benefit. So is there another way to achieve that goal? Because generally speaking, there's probably not another way to digitally verify a loan.
Right.
Second piece is the impact to mortgage-backed security investors. So as we become more digital and more efficient and do, lower the point of which refinance make economic sense through reduction of fixed costs, what will happen is there'll be offsetting impact on security prices. So the option cost will increase, the value of bonds will decrease. So what we have to do is make sure there's compensating offsets in cost to originate to account for the lower bond price at a given rate, to make sure that access to credit is preserved. Because what we don't want to have happen is purchase pricing is increased because of future ability to refinance with no offsetting compensating cost savings on the purchase. So I think those are the two things about balancing both pricing percentage innovation, but also the investor impact with innovation.
I think so. And certainly we've had a messy time with some of these issues lately. And, the more sophisticated we get, people trying to arbitrage and get move things digitally. And then all of a sudden you have to go backwards and bring in the documents and change the DTI. And people are still sensitive to DTIs. And it's an interesting issue. David, I know you had some great observations on this as well with the DTI and gross and net income. You're on mute, David. Sorry.
I'll switch from sign language. Yeah, I think as an industry, the concept of DTI is very important, but I think the way we use it is very clunky. It's based on gross income, and there's a huge variation between identical borrowers in a risk model, between what state they live in. Take-home pay can be very different between two otherwise identical borrowers on a DU system, for example. So as we get more digital and granular data, it'll just improve the risk process because we can look at a person's actual take-home pay based on their tax deductions, what they pay for healthcare, whether it's employer paid or not, if they're in a higher or low tax state. And so I think the more data we get, the more granular we can get, the better risk will be priced. As Eric just described, at the end of the day, you reduce the TBA market as you get, more and more granular on how we risk-based and slice and dice pricing. So there'll be some trade-offs, but it will be better risk pricing with the data.
Yeah, and it, again, another interesting, that shift alone is very important to downstream systems, investor systems, and since it's been gross for so long, I mean, there's so much with just changing that to get into net, but it doesn't mean we shouldn't be trying and working toward that goal. I'm going to switch it up a little bit here. I just got an interesting direct message I thought I'd throw out to you all and let one of you answer. Thanks for talking about direct source data, i.e. the employment data. It appears the utilization rate of these tools is not yet that high. Do you have opinions on why that is? Consumer willingness or cost to use, or is it hit rates? Steve, do you have a thought on that?
I do. It's a good question, and it's a frustrating one to get broad adoption and have it be mainstream. What's interesting is, as we've found, hesitancy around consumer, and this kind of consumer behavior thing, very high propensity to want to validate or willingness to validate their own assets, access their bank accounts in the process, et cetera. Unbelievably so. A lot of people really don't remember their login and password information into online employment, whether it's ADP or Paycom or whoever you use. And there seems to be some unwillingness, more so, when consumers get to that point in the process to say, this is just too much of a hassle. I'm just gonna download these documents and I'll get that to you. I think it is incumbent upon our loan officers and our teams to make sure that consumers understand the advantage of doing that.
Yeah.
And when they do, when they will supply their employment information, they might also be supplying their income documentation at the same time for us. And so we could validate both at the same time. So there's a lot of value in it. But I think when we really put our minds to it and assess this, that's the number one thing that we've seen.
And it's not inexpensive. I know for other asset classes, it's quite inexpensive, but for mortgage, it's very pricey. So my recollection of this, having worked a little bit around this issue, was it's pretty pricey, and you want to see cost savings. Or where the cost benefit starts to be. And all these shiny pennies and cool tech take, a lot of coordination with stakeholders, a lot of consumer allowability or, consent. And, these are complex issues that has not been solved yet, I don't think, that one.
Yeah, I agree. And it's one for just to add on that, I think one of the challenges for people, at least in executive leadership roles, taking on additional tech spend is you have to make sure that you're not actually increasing your cost to produce by taking this on. You have to find cost savings elsewhere, et cetera, and really line up your whole ecosystem, taking it all into account. That's a challenge. It requires more work and focus.
It does. Anyway, so I guess maybe that's part of the TechSprint. They're going to solve all that for us.
Hey, Faith, just real quick on that. Guild has over a 50% adoption rate on people doing this, choosing to share the bank data. And I think in the past, there wasn't much benefit. I mean, it was like either give us 2 months bank statements in PDF or click on a link, enter your ID and password like Steve just described, and go through that process. And people might feel a little leery putting their ID and password out there into a system somewhere. And the same way we felt leery about putting our credit card information on the internet when we started online shopping. I would say as the benefits become more powerful, it's not just saving PDFs of two bank statements. Now it's part of getting approved, yes, no for the loan, or get a better risk-based price. I think the adoption rates will increase, especially as people just get more comfortable sharing the data digitally. And the fact that the consumer controls the data and who it goes to, I think will be an important aspect in the future of why this will be powerful for consumers.
Yeah, my challenge to you, David, and others is that I think the consumers may think they control this. I'm not sure we've solved for control of consumers' data. So why don't we jump to that question? Because we have, as an industry, have to do a really great job downstream of making sure it's traceable. We know no one's selling that data, it's transactional, and consumer privacy is a huge issue right now. And it's getting to be a bigger issue, and the states are certainly passing bills along that, and maybe at some point we'll even see a legislative federal approach to it, although not quite sure. But what let me see, I have data privacy. I know we're not really about data privacy today, but it's all kind of relative. Like if you get that consumer consent, is it clear that that vendor and then that LOS, that POS, and that downstream vendor is not selling data? Probably not. But I actually know some that were ongoing surveilling, the borrower's data when they didn't know that. They weren't aware of that because they were a CRA. So I think there's a lot of vagueness here, and I suspect the CFPB and others will be watching this very closely. So anyone have thoughts on that and how we can do a better job on that? Permission to access?
Yeah, I think specific to us, we really want to make sure that we are gaining permissions throughout the journey, and that we're really doing our part to make sure that we're protecting our members' privacy or letting them know what their options are. I think misuse is causing the majority of the concern. One hot topic right now is trigger leads, and I think we probably all had the ripple effects of that, and consumers kind of coming to us and saying, you're selling my data, and it's not, and it's the misuse that is causing a lot of conversation right now, which is obviously and across the industry it's a big hot topic. But I think that there's got to be controls. There's got to be a way to hold people accountable to those rules. And make sure that they have, proper disclaimers and opt-ins and things like that, so that it doesn't ruin it for the rest of us that are using data in the right way. And so I think that's a big piece, and hopefully we'll see some more oversight over that in the future.
Fair enough. It's just an important piece of this puzzle. I know, Jennifer, why don't you give us some sense of how the data helps you think about your fair lending, efforts at the firm and making good decisions and making sure it's inclusive and not exclusive.
Sure, absolutely. So, as a CDFI, and being a credit union that's very mission-based, I talked about it earlier, data for good. But it has to be checked and validated. We leverage digital underwriting, and Eric spoke to it earlier. We know it's not 100% all the time. Not everybody fits into this credit box for decisions to be made, and so we want to make sure that we're looking at every single loan and looking to see if there's a viable option or alternative product. So every denial that comes through, it gets a second look. We look at everyone 100% of the time to make sure that they're getting a full underwrite on it, to make sure we're making the right decisions. We evaluate trends. We do mapping, which kind of shows our lending across our footprint to make sure where are we light, where are we not, penetrating a certain market, and why are we not doing that? We really look at trends and pivot and change for good. We talked a little bit about using data for performance testing to see, can we take more risk on? Not everybody, again, fits in this box. And I think there's a lot of assumptions on, what scores wouldn't pay versus, a higher loan to value. And so we're constantly fighting that battle and looking at trends to be able to show, hey, these are viable loans. There is an ability to repay, and we're doing all those things. So I think it's important that on an ongoing basis, we continue to create programs and create tools that meet the needs of the community. And that's kind of what we're doing with FinLocker and, some of the other tools that we have to offer. We've developed products based on this because maybe that product offering is not out there, but
Yeah.
it's really, really important that, trending is something that we look at, that we're looking at the decisions being made, we're managing that, and really looking at the trend lines in relation to industry data as well, to see where are we on the mark and off the mark and why, and really dig into that data. So I think that that's a really important piece for us that we always evaluate, and that's something where we continue to do more every year. And even kind of comparing against HMDA data for trends and things like that for lending, and make sure that we're, being an inclusive lender, and where we can improve, being able to identify that, and what are we doing to pivot.
Yeah, that's awesome. Steve, I know we talked at a high level about, some additional thoughts you might have on the fair lending side.
Yeah, I think, it's, we have to balance so many of these things, whether it's liquidity concerns, because we don't write the rules for any of this. We have to follow the rules that are being written. And when it comes to risk, I think the context was around appraisals and kind of taking out, potentially or focusing on taking out bias and appraisals and things like that. And wanting to innovate in that area and taking humans, relying on data more and humans less. Is a huge step forward in that area, and we want to embrace that, and we want to be a participant in it. But it's not limited to that. I think that the tough part for us is making sure that we don't, like everyone else, doesn't create unintended consequences to this as we want to move forward with some pace. And we're not large enough to take significant hits to our balance sheet or our P&L, or lose reputational risk because of going too far outside the box. So we have to balance all of these things, and of course want to be part of the solution.
Yeah, and clearly the regulators are kind of exploring and want to keep learning about with feedback on algorithmic bias. How do we know what our models are telling us? And I know one area that's kind of interesting, if you think about what 3D scanning has done, it's taken out the subjectivity of what room you want to look at, and maybe almost as a marketing tool if you're a real estate agent, or instead of the actual digital footprint, the actual every room in the house is viewed from 360 scans, and an independent person can do that and give that to an appraiser. They have a wealth of data, and they can pick and choose what they want to use from that, of course, but property condition and everything becomes very clear. Those are just huge leaps forward. It's amazing, and for audit purposes, an excellent investor audit, and that's just one little piece of the mortgage process. I don't know as much about title, but I know that's an area that's been costly and frustrating to many. So
I think that's one of those areas that you highlight, Faith, where I don't know what the dispute is about moving forward and improving some of these innovations. Given I think there is areas of debate in a lot of these areas, but the ones where there really is no debate,
that one's a no-brainer. Really, it augments things. It's digitized, so and it's becoming easier to use. The tech is better. I just got a great question. I'm just going to continue to innovate here. We're going to close out and ask for more questions. Bring them in, folks. How are you using data for this team for climate-related financial risks? Do you think an accurate assessment of climate risks and natural hazard risks provide you with a competitive advantage over other originators and servicers? And I have some thoughts, but I'll ask you smart people who are lenders today.
Faith, I'll take a shot at answering part of that question. I think one thing as an industry that we've been completely blind to is utility bills. It's a very critical part of housing. It's non-discretionary. It's a cost to own a home. But we always focus on the PI and the TI, and we forget the U for utilities. And I think the reason we've always been blind to it is there's really no way to track it. Credit risk models suggest that even a small percent change in DTI does impact future default risk alone. But we could have identical properties. One could have energy efficient appliances and one does not. You could have a $200 monthly delta in the utility bills that's not captured anywhere. So what's nice about this electronic bank data is it does capture utility payments.
Yeah.
And so it allows us a way to capture it, digitize it, trend it, compare it. And so what I think that could do, which ties back to the question, is, as far as what we can impact about climate change in the industry is if energy efficient appliances are increased in usage, it lowers the monthly cost to the human living in the house. So it's great for affordable lending, but also then it has positive benefit to use less energy. So as an industry, I think there's a way to kind of connect the dots together to say, what if every low income first time home buyer had some of their critical appliances that energy efficient, installed brand new appliances, lower monthly bills, less maintenance and repair surprise bills those first 5 years in the house. And at the same time, you have a positive story in terms of energy usage. So I think there's some steps like that we can do that the tools are in front of us today to do.
Yeah. And tracking along the way so you can measure that loan's performance if you had that green kind of data information in the loan cost. And I think it's all thematic on what we're talking about. We have less than 10 minutes left, so I want to keep this going. Another little comment to think about is I do think that climate, my gosh, look at us. We've had fires in Canada. We're all suffering from air quality, flooding, historic flooding in Vermont right now, in New York. I mean, hurricanes galore. We are facing climate hazards right and left. And my view, it might be a little bit not a popular view, is that consumers buying a property should really understand the risks that they're buying, and for flooding or those kinds of issues, as well as the investors and on the loan servicing side. And I think we as an industry, there's already a lot of sophisticated climate scores out there for servicers and portfolio lenders for the aftermarket, the secondary market, post origination. But it really should be a 360 view. Consumers should be informed. And I think we've all kind of avoided it. There is a new disclosure. I know Ms. Mo's done a good job on that, but I just bring it up to say there's more to do on that. And we should be pushing it as an industry because it's unfortunate and it hits a lot of people of color and in low to moderate income neighborhoods when it comes to inner city risks as well. So, okay, well, I guess we might end up a little bit at adoption. We are at a point that, we heard Chase, their customers where they have a lot of data, they can make some almost low to no cost process solutions. I mean, that's huge. That so much more access would come through our industry if we had low cost to originate. The friction in the industry is probably the individual nature of how companies operate and compete with one another, right? You like to have that special sauce here and there, and to be too commoditized also will be transformational to this industry as well. So what can FHFA do to help nudge the industry? I guess they certainly have a good start here. What's holding us back from having more adoption? And we have different investors who require different things. I thought, Eric, maybe I'll start with you on that one. Can you give us your kind of sense of this?
Yes, what I'll say is that they've made tremendous progress, FHFA and the GSEs and other investors. But the one piece I think we haven't focused on as much is fungibility, or the ability to sell a digitalized product to multiple investors, even beyond the GSEs. Because what happens today is you get into a very complicated technology schema where a customer may qualify for appraisal waiver with one of the GSEs, but we believe the execution is better with the other. Therefore, the customer is not truly monetizing all that benefit, and you have to have complicated decision trees across digitalization in the process where the customer get an appraisal waiver, but the other GSE will digitally verify. So if we get consistency in these digitally verified techniques be accepted by both GSEs to start, ideally by multiple investors, including the government lending entities, would be the ideal solution, because competition breeds best in price competition, and it allows the full benefit of that digitalization to be manifested to the customer. Because if you have to then say, I got to take a worse secondary market execution to support digitalization, not all that benefit will be accreted into the system.
Yeah.
That's the most critical thing, as we go forward, because if it's only a partial solution and it limits your distribution, it's less attractive.
Yeah. it is a little bit stymieing if you look at USDA Rural, VA, FHA, Fannie and Freddie. From a pure process, we all know policies and impact process, right? You know, everyone has different credit policy, different sense of risk. Do we really see a world where the government would align a little bit with, right now the GSEs have clearly been the leader in tech for over a decade, well over 2 decades. Any thoughts on that?
So I think, I think both Jenny Mae and the government, there's been strong progress across the board, both Jenny Mae, FHA, VA, and rural housing. So I think if we can keep that momentum up, I think they'll be further behind, right? Because they're also innovating on their origination platforms and data. But I think we will eventually get to that. It'll become a necessity because if the cost continues to increase or stay flat for FHA and GSEs continue to reduce that cost to originate,
right?
They're going to need to innovate to provide a competitive offering for many customers. So I think that is a critical driver, and I do think there's strong willingness. The question is, how can we help facilitate as an industry, government lenders and insurers and guarantors getting more comfortable with some of the techniques utilized by the GSEs to get comfortable. I mean, for example, FHA has super streamlined where they don't require an appraisal, which is not equivalent to an appraisal waiver, but there are techniques where they've gotten comfortable with more streamlined, efficient refinancing behavior. Both FHA and VA both have programs. So how do we bring innovation to them in a standardized way they can consume? Yeah.
I mean, it's clearly time of this administration and the agencies have, had amazing positive communication. I see a lot of alignment and a lot of direction. So when you think of fair lending and inclusion and equitable housing programs, et cetera, there's a lot of momentum, and I think tech should maybe rise to the top as well. So, Steve, any thoughts on that one?
I just, I've listened to or read studies where, particularly in improving access, and our partnership with FinLocker has focused on a use case for consumers to around financial fitness, their overall financial fitness and wellness. But, the access, providing access to financial literacy tools and information in underserved communities really can be done to great advantage by mobile solutions. Everybody in those communities has a phone that we know from studies. And so, and they make those phone payments before they make anything else.
Yeah.
And so delivering information to them on an ongoing basis, whether that's just basic financial literacy and information and education, exposing them to opportunities that they might not see themselves in before. Those are ways that I think actual ways to get them in a mindset so they're comfortable and gain confidence that they see themselves in that picture. There's plenty of down payment assistance programs. There's plenty of other programs available. It is getting people to see themselves that that's a priority. It's an achievable goal and something that obviously FHFA can partner with private industry and to make it happen.
Well, we have it looks like 2 minutes left. So listen, you all have such a great grasp of how you're operating, and this is a complex issue, and it's been wonderful hearing from you. Anything more you'd like to impart to your audiences here, and as you think about this week, FHFA has this TechSprint. David, any final parting thoughts?
I would just say that if you look at our entire industry's innovation over the last 30 years, most all of the innovation has been led by the GSEs, and then HUD and the jumbo markets adopt it, after it's been proven. So if we want to really solve the barriers in front of us, we can't keep doing things the same way and be surprised if the results don't change. So I would say more pilots and have the GSEs really lead the industry on innovation, address all these issues. And as we determine what works well, then roll that out more broadly, both to the GSE world as well as to all the other parts of the industry. More pilots.
Excellent. I like more pilots. Me too. Jennifer, thoughts on that?
I would agree. I think that, some of the challenges that we have seen is it's almost harder to provide down payment assistance, grants, the process is different. It's harder, right? And just in the partnerships that we've had with the community and things like that, it's become such a strenuous process, and there's a learning curve with not-for-profits that they have staff coming in and out, right? They're not full of staff. And so, through partnerships and things like that, I think some of them don't want to use some of the resources that are out there because they're so difficult. So if they could streamline, if they could adopt some technology, we're trying to do things where we use the data and deliver, hey, these things, they may qualify for these grants, DPAs, but if the process is so difficult, and there's a lot of repetitiveness and going back and forth, it's really difficult to kind of really adopt these tools. So I really like what Steve said about, the education piece, and, we have to meet our consumers where they are. We say that a lot with our members. Not everybody, they may have a phone, but they may not be very tech savvy and things like that. So making sure that we have different options for everybody, and definitely I think some education would help.
So team, I think we're out of time. I want to thank you. A shout out for Eric and Steve, who any last minute shouts, but anything else?
No, thank you for hosting us today, Faith.
Okay. Well, you guys were great. And I think I learned a lot from you. So thank you. And thanks again to FHFA and the AIR company.
Thank you, Faith.
Have a great week.
Everybody, thank you.